author, please welcome our final speaker of the day, Mr. Peter Schiff.
Thank you. You know, it's actually not hard to see into the future if you just have an understanding of economics. The problem is so many people don't, which brings me to my discussion here. You know, we're here in Jackson Hole, and the Federal Reserve is supposedly, right, about to raise interest rates for the first time in 9 years, after having left them at zero for almost 7 years, right? And this is supposedly going to be like their victory bow, right? After this spectacular monetary performance, right? This is really, hey, it's worked. Everything is great, and now we can raise interest rates. Well, you know, I've been saying for years that the Fed has been bluffing about raising interest rates because the Fed wants to pretend that its policies were a success. Well, if it raises interest rates, it will prove that they were a failure. You see, the whole justification for their policy, you know, when the financial crisis took just about everybody by surprise, the conventional wisdom was, okay, the U.S. economy has been crippled by this crisis, and we need the Fed to save us, to provide us with some kind of crutches that we would use temporarily until we got over the pain. Of course, that puts aside the fact that it was the Fed that crippled us in the first place, but everybody thought that the Fed was going to save us. And what were the crutches, right, that were supposedly going to help us? One was 0% interest rates, and the other was quantitative easing, right? Now, what are the crutches? Quantitative easing, the Fed tossed that one aside, temporarily anyway, about a year ago. But 0% interest rates, we've still been holding on to that crutch and limping on it, you know, like a cane, ever since. But now the Fed is like, oh, we're going to take that cane away. But what the Fed really didn't do, they didn't give us crutches. Right? What the Fed did was knock the legs out from under the economy. They severed our actual legs, and they replaced them with these prosthetics, right, of quantitative easing and 0% interest rates. And if the Fed takes those away, right, the stump of an economy is going to come collapsing down, because everything the Federal Reserve has done since the beginning of the crisis that it caused has exacerbated all the problems that led to that crisis. Right? You have the Federal Reserve trying to pretend that the economy is fine, that the economy is healthy. Right? Yet they've kept interest rates at zero for 7 years. How could the economy possibly be healthy if interest rates had to be at zero the entire time? Why didn't they just raise interest rates a couple of years ago if the economy was fine? You know, if quantitative easing worked, why'd they have to do it 3 times? The fact of the matter is, what we actually have is a bubble. We don't have a recovery. We have a gigantic bubble. And the last thing the Fed wants to do is prick it. Right? But it can't admit that it's a bubble. So what does the Fed do? The Fed keeps talking about how it's going to raise interest rates at some point in the future, that it's depending on some kind of mysterious data that it can't really identify, but somehow it's going to know it when it sees it, but we're not quite there yet. And if the Fed were really about to raise interest rates after 7 years, don't you think they would have made up their mind by now? It's all going to depend on the data that comes out over the next couple of weeks, and then they're going to come to a decision on what they should do after 7 years. The whole thing has been a show. It's been a bluff because the Fed wants to pretend, right? Pretend that the economy is strong enough to withstand higher interest rates, but it doesn't want to actually raise interest rates and then prove that it's not. Right? It's like if your doctor told you, if you woke up and you're in a hospital bed and you're breathing off a ventilator and you're eating off of some tubes that are coming out of your body, and you ask your doctor, what's going on? The doctor says, oh, you're fine, you're in perfect health. Obviously, if the economy needs 0% interest rates, right, it can't be healthy. And of course, you can't have a healthy economy with 0% interest rates. The truth is, again, it is a bubble. In fact, the very monetary policy that inflated these bubbles or reinflated the bubbles in real estate and in stocks is the very policy that deprived the real economy of the resources it needed to actually recover. You have 2 camps, right? You have people who think the Fed should raise interest rates right now, right? Oh, the economy is strong enough, let's raise rates. Then you have the other camp that says, no, the economy needs more help. It's not quite strong enough yet. We need to keep interest rates at zero. Both camps are wrong. The Fed needs to raise interest rates right now, not because the economy can take it, but because it can't. Because, again, it is a bubble that needs to be popped. The sooner we pop it, the better. But, of course, we're going to find out that the Fed didn't save us from the financial crisis. They simply interrupted it, and they kicked the can down the road. And we've now caught up to the can, and the problem is because we delayed solving the problem. See, the financial crisis was the beginning of the solution, and the Fed interrupted it. The market was trying to fix what the Fed broke. Real estate prices coming down were part of the solution. Banks failing was part of the solution. That recession was part of the solution, and the Fed interrupted it. And instead, they gave us an even bigger bubble, and now we're going to have to deal with that. And if you can imagine, right, or we don't have to imagine the problems that Greenspan created, right? He lowered interest rates down to 1% and left them there for, I don't know, a year and a half, and then slowly raised them back up to 5% over the next couple of years, right? And at that point, that was reckless enough to give us the housing bubble, right? And that burst in 2008. And of course, the resolution of that bubble would have been more painful had the Fed done the right thing and let the natural correction flow. But instead, we got more of the same, monetary heroin that crippled us in the first place. But if Greenspan did all that damage at 1%, imagine what's been done after 7 years of zero, after 3 rounds of quantitative easing, after a balance sheet at $4.5 trillion. Just imagine. I mean, the Fed doesn't want us to actually know. That's why it doesn't want to raise interest rates, because that's when you start to see the problems. It's like you don't realize all the dumb things you did when you were drunk until you sober up the next morning and you reflect on it. Well, that is the position that we're in. Now, I want to talk a little bit about Janet Yellen, because I remember, when they appointed Janet Yellen, when Obama appointed her, he promoted her from vice chair to chairman of the Federal Reserve. Right? Remember, he said, this is Janet Yellen. She was warning about the financial crisis. She was warning about the housing bubble, and nobody listened to her. Like, if we only had Janet Yellen at the helm of the Fed, right, none of this would have happened. So thank God we got her now, because she is the smartest forecaster we have, which really shows you how low the bar is there. But that whole thing was a myth, right? If you have some time when you get home, go to Google and just put in there Janet Yellen exposed. And the very first thing that comes up is a YouTube video I made when they appointed her. Right? And what I did is I went back to all the speeches that Janet Yellen made in 2005 and 2006. The very speeches that all the media and President Obama referred to as proof of her, prescience and her warnings, right? And it turns out that she was just as clueless as anybody. The only time Janet Yellen ever mentioned housing bubble was to deny that one existed. In fact, at the peak of the housing bubble, Janet Yellen's forecast was that housing prices were going to keep going up. She said she thought they would probably rise more slowly than they had in the past, but that she might be wrong, that they might rise more quickly. She even postulated what would happen if it turned out she was wrong and there was a housing bubble. She said even if there's a housing bubble and even if it pops, it's not going to be a big deal. Just a little bump in the road. It's not going to affect the economy. That's the warning that she gave. She said don't pay attention to anybody who's worried about the housing market. In fact, one of the funniest things or most ironic things is when she was trying to build the fundamental case for high housing prices, to prove that all the people who were talking about a bubble were wrong, one of the reasons she said houses were more valuable was because they provided homeowners with a tool, and that tool was home equity loans. She said because you can borrow so much money against your house and spend it, that makes the house more valuable. So the very evidence of a bubble was what Janet Yellen used to dismiss the people who were saying it was a bubble. And in fact, when housing prices first started to fall, Janet Yellen in a speech said that she was surprised by the fall because she didn't expect it, but not to worry that it wasn't going to harm the economy. Right? That's Janet Yellen. Yet somehow the media decided to repackage her as if she actually had any idea that there was a financial crisis. She was at the head. She was the president of the Federal Reserve Bank of San Francisco from 2004 right till 2010. She was almost at ground zero of that housing bubble. Had no idea. So if she couldn't see that crisis coming, why should anybody expect her vision to be any better now? Because the truth of the matter is the last crisis was created by the Fed. And so is this one. And they've created it by doing the exact same thing. And what's interesting is, and you saw this little clip of me on CNBC in 2006. And believe me, there's a lot of clips. I was going on for years pointing this stuff out. And people would just make fun of me. But all the people who didn't see that problem, right, they're the same people that think the problems have been solved. They are so convinced, right, that everything is fine, right? That, whoa, people, and even when I was out there criticizing quantitative easing, I said it wasn't going to work. And it hasn't worked, but people still believe it has. Right? And so, Peter Schiff said there'd be inflation. There has been inflation. We know what inflation is. But of course, we know the CPI doesn't necessarily pick up all the inflation that has manifested itself in consumer prices. But we see inflation manifesting itself in the stock market, in the real estate market, in the bond market. Prices of all sorts of things have skyrocketed. But they point to the fact that we haven't had a crisis as somehow vindication of what the Fed has done. Well, you know, the easy part, right, of quantitative easing and 0% interest rates. The easy part is bringing interest rates down to zero. That's the easy part, right? The easy part is to print a bunch of money, to expand your balance sheet. The hard part is to shrink it. The hard part is to raise interest rates back up. In fact, it's not just the hard part. That is the impossible part, right? I mean, it's like, how easy is it to start up a habit? You know, how easy is it to start taking drugs, right? Anybody can start taking drugs. Just try stopping, right? Oh, yeah, you know, you can gain weight real easy. Just eat, then try to lose it, right? That's why everybody like, you know, oh, I'm going to go on a diet next month, right? So you can't come out here and try to claim any kind of success until the Fed ends this program. Let's let them normalize interest rates. Let's let them shrink that balance sheet back down. You know, Janet Yellen actually said, we're going to shrink the balance sheet down to $1 trillion by the end of the decade. Get good luck with that. It hasn't shrunk at all since she made that promise about a year ago. Right? Yeah, like I'm gonna quit smoking next month. How are you going to raise interest rates now that you got us so addicted? How much more debt do we have today than we had 7 years ago? How much more painful is it going to be to try to service that debt if interest rates go up? The fact of the matter is interest rates have to stay at zero because that's the most we can afford. Right? That's just how much debt we have. And it's not just the government, the federal government that has debt. Corporations have all this debt, right? Where do you think they got the money to buy back their stock? That's what's propping up the stock market. It's not legitimate corporate earnings. It's not a growing economy. It's all that cheap money. The same thing that's propping up the real estate market. You know, we have another bubble in the real estate market, but it's not the same buyer. Right? The average American doesn't own a home. Home ownership rates are at the lowest level since 1967. I was 4 the last time the home ownership rate was this low. Right? So why are home prices going up if people can't buy homes? Because the hedge funds are buying them. The private equity funds are buying them. Right? They're getting all that cheap money from the Fed and they're buying up all these homes. Meanwhile, rents keep going higher and higher and higher. The real economy has been contracting the entire time. The Fed wants to pretend that this is a recovery. Again, all they've done is inflated a bubble, but you don't have to look very far beneath the surface to see how weak this economy is. We just had that panel before I talked of some of the younger people. I mean, these are the real victims of the Fed's monetary policy. You know, as you know, the unemployment rate has been falling. One of the main reasons that it's so low is because so many young people have just dropped out. The labor force participation rate among people in their 20s and 30s is at an all-time record low. You know, the other reason that the unemployment rate has come down is because so many people have reluctantly accepted part-time jobs, and they're no longer looking for the full-time jobs that don't exist. And of course, a lot of the part-time jobs they have are low-paying jobs. They're service sector jobs. And a lot of these people in these jobs have college degrees, yet they're doing work that they could have done straight out of high school, except if they had done it out of high school, they wouldn't have all this debt, which is one of the reasons why they're still living with their parents. Meanwhile, the only segment of the society where people are working is the elderly, right? The people that should be retiring are too broke, and so they're still working. People in their 60s, 70s, and 80s are working in the highest percentage ever because thanks to the Fed, they're too broke to retire. The cost of living keeps going up. It doesn't get measured by the CPI, but food gets more expensive, utilities gets more expensive, medical care gets more expensive. Everything is going up in price, except their bank accounts have zero yield. Right? So they're leveraged up in the stock market, but they're trying to make ends meet. They're working these part-time jobs. All the real economic recovery is being prevented. The Fed has got it all dammed up with its monetary policy, but it's afraid to release the dam because it's going to unleash all of these forces, this creative destruction that is so necessary, because we cannot have this genuine economic recovery that would actually lift living standards and create, good jobs for American people. We can't do that unless we allow this phony economy that has been resurrected on the foundation of cheap money collapse. But nobody is going to allow that to happen. Nobody wants to acknowledge that, which is why rather than raising interest rates, which everybody is waiting, like they're looking at for the next report to figure out, is the Fed going to raise rates? And by the way, they've already said that if they raise rates, it's going to be a tiny little itsy bit, like 0.25%. And then they're going to stop, right? Because they want to make sure that the economy can withstand that 0.25%. I mean, that's an admission of how fragile this bubble is. If that little bitsy pin is enough to prick it, right? But everybody is looking for this, but that's not really what they're going to do. See, I think the Fed would be very foolish to raise rates by 25 basis points, because the minute they do that, they're going to set this dominoes. People are going to start to look beyond that for the next one, and the air is going to come out of this bubble much quicker, right? And now what is the Fed going to do? The stock market goes down. We're in a correction right now, right? What happens if it turns into a bear market? Right? And what happens if the economy goes back into recession? This year, 2015, is probably going to be the slowest year for GDP growth of the entire so-called recovery. And interest rates have been at zero for the entire year. So if the economy is this weak with 0% rates, and I'm telling you, if you look at a lot of the economic data points, not that I'm put a lot of validity into any data points coming out of the government, but a lot of the reports that are coming out, the numbers are so bad that we've never seen numbers this low outside of a recession. And remember, the Great Recession, which began in December of 2007, I was doing TV shows, debates with people in mid-2008, debating whether or not we were headed for a recession. We were already in one. And most people thought there was none on the horizon, including the Federal Reserve. Their official forecast in mid-2008 had no recession in its forecast, even though we were already in one for more than 6 months. So you don't normally see this kind of data. So what would the Fed do if they raised interest rates up to 0.25% and they found the economy back in recession, and they found the stock market in a bear market? They found the real estate market starting to go down again. Right? Remember all those banks that were too big to fail in 2008? Well, because they didn't fail, they're way bigger now, and they're even more exposed now to a rise in interest rates than they were back then. So if the Fed raises interest rates, they're just going to have to lower them again and look like complete idiots. Right? They'd rather look, not like complete idiots, by at least leaving interest rates at zero the entire time. So at least when the next recession hits, they can look like they were smart, and they say, oh, see, we were right, we were cautious. And then they're going to launch QE4, which nobody really understands. I think it's inevitable. I said this from the beginning, right? I said it when they launched the very first round of quantitative easing, that they had, checked us into a monetary Roach Motel, that there was no way out. Once they went down this line, that we were in for the duration. You live by QE, you die by QE. I said we'd have more QEs than Rocky movies. And I think they had 6 of those. And of course, they got progressively worse. And so I think QE4 is going to be even worse than the last rounds. And ultimately, and I see this thing is flashing, ultimately where we are headed is to a dollar crisis. And I know right now, and over the last several years, the dollar has rallied. Why has the dollar rallied? Because everybody is convinced that the Fed's monetary policy worked, right? Everybody is waiting for the Fed to raise interest rates. And it's that fear or that anticipation of tighter monetary policy coming out of the Fed that has caused the dollar to rise. The market is trying to price that in. They've believed all the hype and all the propaganda that this bubble is a real recovery. But the same people were fooled by the phony recovery of the housing bubble years or of the dot-com years. And so when people realize that, wait a minute, this is not the end of it, right? Quantitative easing isn't over, right? The Federal Reserve is not finished printing money. They're just getting warmed up. That the lion's share of the printing is in front of us. That the Fed's balance sheet is not going to shrink. It's going to start expanding again. It's not going back to 1 trillion. It's going up to 10 trillion. That there's no way to stop this. Because if the Fed ever let interest rates go up, the party would end. They would have to admit that they're insolvent. You have all kinds of countries now around the world admitting that they can't afford to pay their bills. Well, we can't pay our bills either. We've got more bills than they do. It's just that our creditors haven't figured it out yet, so our interest rates are still low. But if interest rates went up, we would have to make the same acknowledgement because there is no way that we can service this mountain of debt at a market rate of interest. So the Federal Reserve is going to have to do everything it can to keep this party going. And what's going to end it is going to be the coming dollar crisis. Because then when people realize it's QE infinity, it's 0% interest rates forever, the dollar's going to turn. Prices are going to rise precipitously in the United States, not financial prices, but the prices of real goods and services. And the Federal Reserve's 2% so-called inflation ceiling is not going to be a ceiling because they're going to let it go to 3, they're going to let it go to 4, they're going to let it go to 5, and they're going to first say it's good for us. They're going to say, oh, we dodged a bullet. At least we didn't have a lower cost of living, right? At least we saved us from deflation, right? So they'll congratulate themselves for having saved us from that. And then they'll say it's transitory and, but at the end of the day, it doesn't matter how high inflation goes because there's nothing these guys can do to stop it because they're powerless to do it because the only way to do it would be to raise interest rates dramatically and they don't have the stomach for that. And so when the markets realize that inflation runs out of control, then we get that dollar crisis, we get a precipitous plunge in the dollar, and then we're going to have no choice. The market is going to force the Fed to do the right thing because if it doesn't, right, then it turns the dollar into monopoly money. Then we run into a hyperinflation, which would be the complete worst case scenario. Hopefully we can avoid that, but we have to make sure that the Fed ultimately does the right thing and the nation does the right thing on the eve of that dollar crisis, because otherwise, look, the only solution I'm going to have for the young millennials is going to be emigration. And I know I'm out of time, but what I want to announce, I've got my latest book, The Real Crash, America's Coming Bankruptcy, How to Save Yourself and Your Country. I revised that book about a year ago, and I have about 30 copies with me now, and I'm hoping to leave with no copies because the duffel bag that I brought them here with broke. So I'm going to be autographing those books on that table, the red and white table. Thank you.